Welcome back. It's time now for the Monday edition of our daily Need to Know feature, where all your questions on money matters are answered by our team of experts. Now, Greece is the latest country to have to tackle a debt crisis in their economy. And this drove tonight's question from Richard, who asked if it's ever a good idea for a country to walk away from its own debt. And eNCA resident economist Trudi Makhaya answered this one for us.
The basic answer is that it depends. For a country to go to its creditors and say that it's not able to meet its debt obligations carries some risks. It creates the perception that this country is not able to manage its finances and to honor its commitments, and therefore makes it more difficult for it to raise debt in the future. However, there are often very good reasons why you might want to wipe the slate clean. It could be that the debt was acquired under very dubious circumstances, say by a dictator, and it wasn't used properly, and the country has no hope of paying back that money. Now, there's no sense in forcing that government to keep paying interest payments rather than spending in education, health, and other productive investments. So it does make sense to let the country walk away from its debt obligations. However, investors have to be convinced that it's not a regular occurrence, it's a once-off, and that the money that is saved from not having to meet those interests and capital repayments will be used productively going forward.
Right, let's take a look now at the markets. We start in the US, where stocks struggled in negative territory, with investors still jittery in the wake of disappointing trade data from China and Greek debt drama. Higher oil prices lifted energy stocks, but not enough to push the market into the green. In Europe, UK stocks dropped for a second straight day after disappointing Chinese trade data fueled fears of a global economic slowdown. Heavyweight bank HSBC Holdings gave up 1.4% after reports that the bank helped thousands of wealthy clients evade tax. Here at home, after spending most of the day in the red, the JSE staged a comeback moments before the close of trade. South African miners benefited from a weaker rand, while the remaining major indices finished lower. The all-share closed above 52,000 points for the first time this year. And looking at the commodities, gold edged up from a three-week low as European equities were hurt by soft Chinese trade data and worries about Greece. Oil rallied for a third day in a row as OPEC said it sees demand for Brent on the rise. On the currency market, the rand was weaker late in the day after better than expected US job numbers buoyed the dollar last week. The euro weakened due to Greece's debt woes. And that's it for today's edition of eNCA Moneyline. And remember, we love hearing from you, so send us your comments and questions via email to moneyline@enca.com. You can also tweet us using the handle @eNCA News and hashtagging eNCA Moneyline. Take care.